Hey everybody, Joe here from Avalon. In this video, I'm going to take you through the important information you need to know about the Registered Retirement Savings Plans, or RRSPs. I'll explain what RRSPs are and how they work, and how to get the most out of your RRSP. We'll get into the details about RRSP contributions, how they reduce your taxes, and how to avoid penalties. I'll talk about the different types of RRSP withdrawals, including Homebuyers Plan and Lifelong Learning Plan as well. And lastly, we'll explain how to best use your RRSP to save taxes overall. So all that and nothing else coming up. Let's start with a general overview of what the heck RRSPs are before we get into the details. So RRSPs are investing accounts that are made available to Canadians by the Canadian federal government. I've used this analogy before and I'll use it again here. I like to think of an RRSP account as a big bucket that I can dump cash into. The cash can then be invested in various different types of investments, and it's all done within that bucket. For example, let's say I took $1,000 and dumped it into an RRSP bucket. The RRSP bucket now has $1,000 of cash sitting in it, and I could then use that cash to purchase investments of various types. Let's say I purchase $1,000 worth of shares in a publicly traded company like Shopify, for example, and the investment is still in the RRSP bucket, but now the cash has been replaced by an investment in Shopify. So what's the point of investing inside your RRSP bucket? I'll get to that next. With an RRSP, you get a tax deduction when you transfer money or investments into that registered account. In the previous example where I moved $1,000 of cash into my RRSP bucket, it was called an RRSP contribution. So with that $1,000 contribution, I also get a $1,000 deduction on my personal taxes in the year of that contribution. This means that you'll pay less personal tax in the year that you made the RRSP contribution. Then the money inside the RRSP grows tax-free while it's inside that RRSP bucket. So going back to our example, if I earned some dividend income on my Shopify investment, that income would flow into the RRSP bucket, but because it's still within the RRSP, I wouldn't have to pay tax on that dividend income. So that's pretty nice. So it's only when I withdraw funds out of the RRSP account that I would have to pay personal tax on that withdrawal. The amount that you withdraw gets added to your personal income for that year, and then you then pay tax on the withdrawal amount at your marginal tax rate for that year. So if you're not sure what marginal tax rates are or how they work, check out our link in the description below for more details on that. So here's a recap of how RRSPs work. You contribute cash or investments into your RRSP account. You then get a personal tax deduction when you contribute to your RRSP. Your investments grow tax-free inside the RRSP, and funds are only taxed when you withdraw them from your RRSP account. Next up, we'll look at what types of investments you want to hold within your RRSP account. The government has placed some restrictions on the types of investments that can be held within RRSPs, but these include cash, mutual funds, securities listed on designated exchanges like the TSX or the New York Stock Exchange, for example. Guaranteed investment certificates can be held, so GICs, bonds, and some shares in small business corporations. So that's a pretty large list of investments and should cover most investors who aren't looking for higher risk or alternative investment vehicles. Now that you have an idea of what RRSPs are and how they work, let's look at who is eligible to open an RRSP account. In Canada, any person who has earned income and is a resident of Canada is eligible to open and contribute to an RRSP. This includes both employees and self-employed individuals. To open an RRSP account, you need to have a social insurance number and open the account with a financial institution such as a bank, a credit union, or investment firm, something like that. It's important to note that the contributions to your RRSP are based on income reported on your tax return. If you haven't filed a tax return in Canada yet, you won't have contribution room available to use your RRSP account yet. I'll talk more about RRSP contribution room in a bit. The last thing I'll mention about opening an RRSP is that there is also a maximum age limit to contribute to your RRSP. December 31st of the year that you turn 71 years old is the last day you can contribute to your RRSP. After this age, you can convert your RRSP to a registered retirement income fund, or an RRIF, or an annuity, but it's a whole other topic and we'll discuss that in another video. Investing in RSP has two major benefits. The first is that it allows you to reduce your taxes in the current year and defer paying taxes into the future. And the second benefit is that your investments are allowed to grow tax-free within the RSP account. When you contribute to your RSP, you receive a tax deduction in the year of contribution. You effectively reduced your taxes in the current year, which means you have more cash to invest or to use for buying stuff. So when you withdraw the cash from your RSP in retirement, that cash is taxed at your marginal tax rate. You've deferred the taxes on that money until retirement. The tax deduction from an RSP contribution is especially helpful for Canadians who are in high tax brackets. I'll use an example to show you why this is the case. So let's say that Mark works at Macrodata Refinement at his office in Vancouver. Mark earns $150,000 per year plus performance bonuses. At his income level, Mark's marginal tax rate is around 41%. So this means he'll pay $41 of tax for every additional $100 of income that he earns. It also means that he'll save $41 of tax for every $100 that he contributes to his RSP. If Mark contributes $10,000 to his RSP in 2022, he's going to save $4,100 from his RSP contribution. Moving ahead a few years, Mark decides to retire in 2030 and will earn pension income of $40,000 per year after that. Assuming 2030 tax rates are similar to those in 2022, Mark's marginal tax rate will only be around 20% from his lower income level. If Mark withdraws $10,000 from his RSP after retirement, he will only pay around $2,000 in tax on the $10,000 withdrawal. He contributed $10,000 in 2022 and saved $4,100 in taxes. Then when he took out the cash from his RSP, he was in a lower tax bracket and it only cost him $2,000 in taxes at that time. He was better off because he contributed to his RSP when his income was higher, and he'd also deferred paying tax on those funds until retirement. This is how registered retirement savings plans were designed. It's expected that people will contribute to their RRSP accounts when they are in their highest income earning years. Then when their income drops off at retirement, they can take money out of their RRSP accounts and pay tax at a lower rate. It's pretty nice. So that's the plan. Contribute to your RRSP when your income is high, withdraw funds from your RRSP when your income is lower. Let's talk a bit more about RRSP contributions. Each year, you will have limits on the maximum amount that you can contribute to your RRSPs without incurring penalties. The contribution limit for a given year is typically 18% of your earned income from the previous year, up to a dollar maximum that is set by the CRA for that year. For the 2023 tax year, the contribution limit is 18% of your earned income from 2022, up to a maximum of $30,780. So for people who haven't used their full contribution room, the unused portion of the contribution limit is carried forward into future years. So that's pretty nice. You can find your current RRSP contribution limit in your notice of assessment from the CRA. It's calculated based on the previous year's income and previous year RRSP contributions, less any pension adjustments that may exist. It's also important to note that any RRSP contributions made above your contribution limit will be subject to a penalty of 1% per month. The government provides a bit of wiggle room, allowing you to contribute $2,000 over your limit before penalties kick in. However, the $2,000 amount can't be deducted from your income, so it's still important to stay within your contribution limits. Penalties can add up quickly too. For example, if you over-contribute to your RRSP by $12,000, you would receive the $2,000 of wiggle room, but then would be assessed on a penalty for the remaining $10,000 of over-contribution. That penalty would equal 1% of the $10,000 of over-contribution per month. That's a penalty of $100 per month until you withdraw that excess amount. This is why it's very, very important to track your RRSP contributions and your contribution limits. You can check out your most recent notice of assessment from CRA to see your available RRSP contribution room. Next up, we'll discuss spousal RRSP contributions. A spousal RRSP is a type of RRSP that is set up in the name of your spouse or common law partner for the benefit of them. Spousal RRSP contributions are made by the higher income earner to provide retirement income for both partners when they reach retirement age. The higher income partner makes contributions to the spousal RRSP and also claims the deduction on their tax return. When the funds are withdrawn, they are taxed in the hands of the lower income partner, who will likely be in a lower tax bracket. The goal is to even out the retirement savings between the two partners. So this allows the couple to withdraw a similar amount of money from their RSPs when they retire, which can reduce their overall tax burden. When making contributions to a spousal RSP, the contribution is made by the higher income earner. The contribution is made to an RSP in the name of the lower income spouse. The contribution room of the higher income earner must be sufficient to accommodate the contribution. So one last thing to be aware of for spousal RSPs is there's also a 3-year attribution rule for withdrawals. So if you're getting a bit tricky, this rule says that if the lower income spouse withdraws the funds within 3 years of the contribution, the withdrawal will be taxed as income of the higher income earner. Spousal RSPs are good to be aware of if one spouse earns significantly more or has significantly more retirement savings than the other. The last note I have for you on RSP contributions is the annual deadline. So for contributions to be deductible on your current year's tax return, they can be made throughout the calendar year and all the way up to March 1st of the following year. So for example, if I contributed $5,000 on July 31st, 2022, and another $5,000 on February 28th, 2023, I could deduct $10,000 from my 2022 income, assuming I had enough contribution room available, of course. All right, let's move on to RSP withdrawals. Withdrawals from an RSP are typically subject to income tax because contributions were made with pre-tax dollars. If you withdraw money from your RSP before you reach the age of 71, the withdrawals will be subject to income tax paid at your marginal tax rates. If you withdraw money from your RSP before your RSP matures at age 71, you may also have to pay a withholding tax. For Canadians outside of Quebec, the withholding tax is 10% on the first $5,000, 20% on amounts between $5,000 and $15,000, and 30% on amounts over $15,000. So when you withdraw from your RSP, your financial institution will provide a T4 RSP showing the amount you withdrew and how much tax was withheld. You will then need to declare the withdrawal amount on your personal tax return in the calendar year that you took out the funds. The good news is that the withholding tax is treated the same way as regular income that you pay. So if you've paid more tax than that was necessary upon filing your tax return, you'll get a refund for the amount that you overpaid in tax. Another important consideration on withdrawals is that you don't get your contribution room back when you withdraw funds from your RRSP. The Canada Revenue Agency only lets you count that contribution once. You can't add back the amount of withdrawal to your existing contribution room. This means you'll decrease the amount of possible funds in your RSP, reducing the potential tax-free growth you would otherwise enjoy. Taking money out of your RSP account before retirement can impact your long-term retirement savings. It's a good idea to look for other ways to fund your cash needs before taking money out of your RSP account for sure. The Homebuyers Plan, or HBP, is a program offered by the Canadian government that allows first-time homebuyers to withdraw up to $35,000 from their RSP tax-free to use towards the purchase of a home. The withdrawal amount is considered a loan and must be repaid to your RSP over a period of 15 years. To be eligible for the HBP, you must meet the following criteria. You must be a first-time homebuyer and have not owned a home that you have lived in for the last 5 years. You must have a written agreement to buy or build a qualifying home for yourself. You must intend to occupy the home as your principal place of residence within 1 year of buying or building it. And you must not have previously participated in the Homebuyers Plan. You can withdraw up to $35,000 from your RSP with this program. And if you're married or have a common law partner, it's also possible to split the withdrawal between the two of you. So you can each withdraw up to $35,000, allowing you to access up to $70,000 total towards the purchase of your home. You will need to start repaying the borrowed funds to your RSP after 2 years. So you'll find the required payment amounts on your annual notice of assessment. And if you don't make the required annual payments, that same payment amount will be included in your income and you'll be subject to tax on that. One last note here is that your RSP contributions must remain in the RSP for at least 90 days before you can withdraw them under the HBP program. Check out the link in the description below for a full rundown of the Homebuyers Plan. The Lifelong Learning Plan, or LLP, is a similar program offered by the Canadian government. It allows individuals to borrow funds from their RSP to finance their education or training. Now, these funds have to be either repaid or included in your income if they're not repaid. But the LLP is designed to help individuals return to school or upgrade by allowing them to withdraw from their RSP without paying any tax on those withdrawals. To be eligible for the LLP, you must meet the following criteria. You must be a resident of Canada. You or your spouse or a common law partner must have contributed to an RRSP. You must be enrolled in a qualifying educational program on a full-time or part-time basis. So under the LLP, you can withdraw up to $10,000 per calendar year, up to a maximum of $20,000 total. Withdrawals under the LLP must be used within a specific period of time, generally within a 4-year period. If not used within that time frame, the withdrawals will be considered taxable income. The borrowed funds will need to be repaid to your RSP over a period of 10 years. Generally, you will repay 1/10 of the total withdrawal amount each year. So repayment starts the earlier of when you cease to be a qualifying student or the 5th year after your first LLP withdrawal. You will receive an LLP statement of account each year with your notice of assessment from CRA. This statement will show withdrawals, LLP balance, and the amount that you'll have to repay in the following year. If you're curious to learn more, check out the link in the description below for detailed income on the lifelong learning program. All right, so let's summarize some of the most important bits here. There are several ways to use your RSP to save taxes. The most common way to use an RSP to save taxes is by making contributions to the plan. So when you make a contribution to an RSP, you can deduct the amount from your income, which can result in a lower tax bill. By contributing to an RSP in the name of a lower income spouse or common law partner, you can shift income to a lower tax bracket, which can result in a lower overall tax bill for both partners. Any investment income earned within an RSP is not subject to tax until the funds are withdrawn. This means that investments within an RSP have the opportunity to grow tax-free, which can result in a larger sum of money being available to use for retirement. By meeting the conditions of the Homebuyers Plan and Lifelong Learning Plan, you can withdraw funds from your RSP to build a home or finance your education without having to pay taxes on those withdrawals. All right, so there's your RRSP rundown. You should have a good basic understanding of how RRSPs work and how you can benefit from them. In future videos on this channel, we'll continue to dive into other ways you can save tax and build wealth. So subscribe and hit the bell if you want to get notified when those videos are released. We're also here to provide general guidance on the tax side of things, so please don't hesitate to send us your questions in the comments below. And if you have enjoyed this video, or it's been helpful for you at all, we really appreciate if you hit that like button. We really appreciate all the support we've been getting on the channel, so thank you so much, and we'll see you in the next video. Cheers.